Very special guest today. You rarely see him on TV. The last time I saw him on TV was 3 years ago when he came to India, and that's Timothy Moe, Managing Director, Global Investment Research with Goldman Sachs. Tim, so nice to have you on ET Now. Thank you for joining us. Now, Tim, I understand the importance of risk and the starting point of valuations. While the India story is a promising one, if the starting point is today, which is 9th of April, how do you see the next 3 years going? Could next 3 years be era of or a patch of low returns or high returns?
I mean, it's a great question. Thanks for asking it. And I'm gonna give you a kind of a two-pronged answer. And I'm not trying to be a two-handed economist here, but I think there really are two important points to bring out. So number one is that if you look through financial history, and there's tons of textbooks and learned studies and all this, you know, one of the most significant determinants of future return is the price you pay at the start of your investing period. So it's not surprising if you pay a high price, it's harder to have a higher return over time. You generally had a much better potential for return. So just purely from that, it would say if your starting point for India is paying over 20 times earnings, then you shouldn't expect as strong returns as perhaps we've enjoyed over previous, call it, 5-year investing intervals. However, and this is a really strong caveat to that, India looks like it will be able to deliver quite strong earnings growth because of the very favorable underlying fundamental dynamics. And on top of that, and we've written a detailed paper on this late last year, we are very excited about the theme of what you might call the increasing digitalization of the Indian equity market. There are over 60 unicorns in the private sector that have been formed, and those will be coming into the market through listing. And as they come in, the configuration of the Indian index will start to shift, and will take on more of this kind of digital economy, structural growth component. And that's something which, for example, in China was a terrific 10-year investment theme. A lot of wealth was created. We think of a similar dynamic that's taking place in India. And then just the last item I'd like to mention is that the outlook for a lot of other parts of the region, and here, there's a lot of concern about China, isn't looking quite as good as it was before. So I think that India, that high relative valuation we spoke about, I think it is high, but I don't think it's going to come down to perhaps where it has been, over the past 10 years. I think it stays high. So if you roll all this together, I think, yes, returns will be somewhat lower than we've enjoyed, but I still think they're going to be good in absolute terms, and India will be a good place to be investing. So the bottom line is that if investors can either see some sort of a price correction in India, which will give a better entry point, or we can wait for some time to let the earnings catch up and let the multiple just naturally compress, then I think that will be a very good time to re-engage in a more active manner in a positive Indian investment thesis.
So Tim, irrespective of the timeline we are talking about, in history markets, they follow a cycle. It starts with skepticism, then there is participation, followed by euphoria, bubble, and then the bad word bust. What stage do you think Indian markets currently are at?
Great question. We have a similar way of kind of characterizing the investment cycle. I'd say right now we're in what we call the growth phase. So we have a lexicon which is despair, which is the bear market, and then we call hope, which is when the market rallies before the fundamentals change, and that's when you get PE multiple expansion. And then you get the growth phase, which is typically when multiples compress, but the underlying earnings growth comes through, and then you get your sort of euphoria blow-off stage, and then the whole cycle tends to repeat. I think right now we're in a period where it's really the growth phase where valuations have expanded, and now it's going to be the earnings growth which catches up. We'll probably see some forward valuation compression, but as long as the growth comes through, I think we're going to be in that longer growth phase for India.
You may, Tim, not this forum, but some other forum, and it was a couple of years ago, you made a call that you see a lot of domestic money coming into India. It was an outlier comment a couple of years ago because domestic institutional investors only sellers in equities. But now things have changed. You mentioned flows. Well, $30 billion of FI selling, which was gobbled up by domestic institutional investors. Could this be the differentiating factor? The differentiating factor where Indian asset allocation changes at the household level, because this, in a sense, will really change the way how liquidity flows into equity markets.
This is a very important point, and it's something which is, I think, particularly critical to all your distributors, who are the attendees at this conference, because I think this really is sort of their lifeblood, so to speak. And really the point here, the concept is the term we've dubbed, so to speak, is what we call the financialization of Indian household savings. So the concept is that Indian households save a lot. They've got a very strong and robust balance sheet, but the majority of it is in property, it's in cash, it's in gold, either around mother-in-law's neck or in the drawer, but not that much of it is in financial assets. And our view, based upon looking at how various other economies have developed over time, is that there's going to be a development of financial market investment, and there will be a structural shift and embracing of financial market investment by the Indian household. And so we think there's a long way to go in this, because if you look at the current deployment, we're still well below 10% of the household balance sheet being invested either directly in the equity market or through mutual funds or other similar intermediaries. So there's a very clear long-term structural trend of increasing share of financial assets in the household balance sheet, which itself is going to continue to grow as India's economic growth increases and people's wealth rises. So we think this is a really strong, fat, long-term trend, which is quite positive. And I think underpins, as you asked, kind of that sort of higher valuation for the Indian equity market. But if at the risk of becoming perhaps overly enthusiastic, I think the other kind of additional factor which we can look forward to, which could be a turbocharging factor on top of that domestic demand for equities, is the return of the foreign investor. I mean, for example, I'm in New York right now. I've just been going around seeing investors in Boston, New York, Connecticut, and so on. So I've just had 30 conversations with U.S. investors, and the general take in India is, yeah, we like it, but we had been overweight, looks a bit expensive, we pulled back, but we're looking to re-engage at some point. So I think that $20 billion of net foreign selling gives foreign investors the opportunity, if you would, to reload later on if they again become more enthusiastic. So I think that the combination of that secular structural deployment of Indian household balance sheet into the equity market could be complemented by a return of the foreign investor, and that could actually give us some pretty handsome returns for Indian equities at some point down the line. And I think that's an important thing to keep.
Tim, I'd like to draw your attention to the most important financial headline last week, which is that the US bond yields have reversed. And historically, when that has happened, that has led to recession. How should Indian investors react to this? Because recession is bad news for everyone.
This is true. So there's a few points that are important that we need to unpack, because you said this is super top of mind. Just to deal with the recession question, first. I mean, of course, if the U.S. goes into recession, that's not good, for anyone. I think in relative terms, India will stand out as one of the more attractive places fundamentally, because India is still enjoying sort of the tailwind of recovery from the COVID-induced setback. And so, if trend growth is here, kind of COVID drove India's growth below that. We started to recover. We're still trying to getting back to where we could be growing at, and that's indeed why we think the economy could grow somewhat over 8% this year. So I mean, there's obviously good potential trend growth, but then on top of that, you get a bit of catch up, which we still have to enjoy. And so I think India and other parts of Asia indeed stand out in happy contrast to the risk in the U.S. of actually tipping back into recession, because you got just a completely different kind of monetary and fiscal policy cycle, as well as kind of growth dynamic, which underpins our preference for sort of parts of the world, including India, away from the U.S. But that being said, if the U.S. tips into recession, typically the equity market, would sell off to some degree. And we've noted that in the last 30 years, every time the U.S. has gone down 10% or more, Asia will follow. It may follow to a lesser degree, but it's going to be a depressing effect. So I think that is true, and it is something that domestic investors in India need to keep in mind. But there's a subtlety here. Forgive me if I'm getting a little bit sort of into the weeds on this, but the inversion that you spoke of is happening in what is colloquially called as the 210 spread, the difference between the 2-year yield and the 10-year yield. And the reason why I mention this is that we need to be careful about what signal we are extracting from that inversion of the yield curve. And the reason I mention this is that it's happened because the 10 years yield hasn't risen as much as the 2-year, which is why the curve is flattened and slightly inverted. The reason why 10 years aren't higher than you would think they should be from a fundamental perspective, given where inflation is in the US and so forth, is that from a global cross-sectional perspective, US yields look pretty darn attractive because German bonds are yielding currently 60 basis point, Japanese JGBs are yielding 25 basis points, and the Bank of Japan just came out and said they want to keep those there for what's called yield curve control. So my point here is that for the global pool of fixed income capital, which is quite large in the trillions of dollars, even if the US looks overvalued, relative to what you get elsewhere, it looks great. So what that's doing is it's suppressing kind of artificially for demand supply reasons, the 10-year. So what I'm getting with this is that the signal is kind of distorted by this technical kind of flow of funds issue and may not be giving us as clear an indication of actual economic recession risk as it typically does in other circumstances. So that's why that's the point I wanted to make. And again, as I said, we've got various models that sort of look at the circumstances economically.
Okay, now Tim, closing comments. If I look at the financial history, there are decades where nothing happens. And there are times when one market really dominates that decade. Japan in 80s, US because of that TMT boom in 90s. Last couple of years have been dominated by US blue chip stocks. Before that it was China. What are the chances this decade belongs to India?
Yeah, I mean, I actually have a lot of sympathy for that view. And this gets back to the kind of the longer term comments I was making before about this change within the Indian stock market and economy, this greater embracing of the digital economy. And forgive me if I'm telling people here something that they already know and living and breathing, but we think there's actually a lot of positive potential in terms of what you might call the digital common good, which has been put out. And this, of course, is the India stack of the Aadhaar, biometric identification, the banking, the capability of doing digital banking, the KYC capabilities digitally, and then of course the universal payment interface, which allows for cashless transactions. The combination of this is the analogy here is with the construction of the U.S. highway system in the 1950s, which was something that had tremendous ripple effects. It was sort of a common social good that was put in place, but that connecting the U.S. by that highway system engendered a huge growth, productivity spurt, and a growth spurt. And I think the analogy here is you've got a digital highway which has been put in place, which is a common good, and is enabling the rapid formation of companies on top of that. And it's also including the vast majority of the Indian population, which previously was in the informal or the gray economy. And the potential here is that for however strong India's growth could be, that digital good and investment which has been made could actually boost up India's growth rate, even further. We don't know what that is. Could it be 1 percentage point or, more or less? But it certainly is a positive. And as that starts to be explored more significantly, that could lead to a structurally higher growth and better earnings and so forth. And that could give us a much better longer term Indian investment story. So, we're on board with that longer term picture. It's just right now at the current entry price, getting back to your previous question, we're a little bit less enthusiastic. So, really, we're sort of buyers on a pullback. The longer term structural story should be positive. And that's how we kind of square the circle on that.